All right. Good evening, everybody, and thanks for joining us. My name, as most of you know, is John Bodnar. I'm a certified financial planner and the founder of Bodnar Financial Advisors. Next to me is Justin Esposito, a fellow certified financial planner here at Bodnar Financial. And tonight, we are your equity investing cruise captains. But before we dive into this, no pun intended, diving lifeboat drill. Funny, right, Jack? Couple of housekeeping chores. One, you are muted. That is on purpose. I don't need to hear your dogs barking or your cats meowing or my grandson's in the background saying, "Oh, look at Paul. He got a haircut." All right. So you're all muted. Number two, we're going to be turning the camera off soon, and you'll all be in watch mode also. Again, I want you to concentrate on the slides, not my new haircut. All right. But we will return, Justin and I, at the end. We have a little surprise for you,
Yes, stay
but you
around.
will
Stay
see
around.
us again, so stay around. And finally, this is being recorded. It will be uploaded to our Bodnar Financial YouTube channel. Yes, there is such a thing as a Bodnar Financial YouTube channel. Would it be the year 2025 if there wasn't a Bodnar Financial YouTube channel? So Justin will be sending all of you that RSVP'd a link to this recording. So I am going to ask Justin to turn off the camera.
All right, hold on a second here.
And we'll dive in here. Because the first thing on our agenda for this voyage is a lifeboat drill. And there's a reason why lifeboat drills are at the top of the agenda for every cruise you've ever been on. One, it's international law, right? But also, it's nearly impossible for people, passengers on a ship or a passenger on a lifetime journey of successful investing, to learn new things when they're feeling scared. That's why we run lifeboat drills, both on the cruise ship and at Bodnar Financial, when people are not scared, when the sky is blue and it's sunny and everything is great. That's how investing, successful investing works also. We want to educate ourselves in the comfort of a bull market so that we are mentally prepared to rise to the occasion when that muster sound goes off, that beep, beep, beep sound, all right? And you go from not on a cruise ship, but in your investment portfolio, and it becomes a bear market. Right?
Well, we are definitely in a bull market now.
We are definitely in a bull market, Justin. In fact, we are well into the third year of a bull market. For most of us, the first 3 quarters of 2025 have been very successful in pursuit of our most cherished lifetime financial goals. All right. Look, the S&P 500 year to date is up almost 15%. So I think that makes it the perfect time for a world famous Bodnar Financial Lifeboat Drill exercise. So, what is a lifeboat drill, you might ask? Our lifeboat drills on a cruise ship is called a muster drill, but our lifeboat drills are an exercise we do in our office to help long term, plan driven investors mentally prepare for the natural ups and downs of equity investing. And we are all long-term, plan-driven investors at Bodnar Financial. We are not day traders here. We help clients create balanced portfolios that will work to fund 3-decade retirements and family legacies. So when we say investing, we're talking about staying in it for the long haul.
Yeah,
Staying in it for the long haul is not an easy thing to do, is it, Justin?
it's most people can't hack it, to be honest, Sticking to a financial plan for decades, it takes clarity of purpose. It takes faith in the future, and it takes patience and discipline. Okay? The lifeboat drill exercise exists to strengthen all of these mental muscles: our clarity of purpose, our faith in the future, patience, and discipline. It helps us visualize the math of a down market so that when one comes, you are mentally prepared for it. So let's start with the first thing on this slide. Clarity of purpose. Why are we doing this to ourselves? Why are we riding the thrill ride of stock market volatility year over year? And the answer is simple. I mean, we do it for returns, right?
We do it for returns. That's right. That's right, Justin. We do it for returns. The thrill ride of stock market volatility has been the largest wealth creator in the history of the world. In the history of the world, nothing's been better. It'll maybe winning the lottery. Now that's pure luck, and the odds are awful, right? But the greatest wealth creator in the history of the world are the equity markets. It allows families to increase and protect their purchasing power across multiple generations. This is how we beat inflation, boys and girls. I apologize for this busy chart, and there's a lot going on this chart. But this busy chart on your screen shows us that since 1926, technically December 31st of 1925, right? US common stocks have delivered an average annual return of more than 10%. It's way up there in the top corner. If you give, hopefully you can see my cursor way up here in the upper left-hand corner, right? That now, look at the competition, right? The average rate of return on a treasury bond is only 4.9%. And it's 3.6 down here in T-bills. It's 3.6, which historically has been equal to like what money market rates have paid. So getting real returns matter, because the answer to that question that Justin just posed, why are we doing this? Why are we equity investors? The answer is to make sure that our real returns outpace the dual impact of income taxes and inflation. That's why we do it. If you could see me in the office right now, I'm doing air quotes around the word real returns, air quotes, because income taxes and inflation are taking a cut from the returns you're seeing on this chart. Now, I know this is hard to believe. I'm getting a little ahead of myself. I know. Anyone who knows John Bodnar knows that never happens, and I would never get ahead of myself. But I'm getting ahead of myself here. So, Justin, why don't you walk through exactly how these returns work on the next slide? Because remember, real returns matter.
They certainly do. That's right, John. And inflation, it really needs to be the steady drumbeat in the back of every investor's mind. Let's look at the average returns for all those investment types and stack them up against 3% inflation. On the left side of the chart, you see the historical averages from the previous slide. And on the right side, you see what John is referring to as, air quotes, real returns. That is the amount left over after inflation takes 3% of your purchasing power. And after taxes, it's really even less, but we don't count for taxes on this chart. So you can see that the average return of 10% for common stocks, real return, is only 7% after inflation. 10% minus the 3% inflation gives you a real return of 7%. And 7% is multiples higher than cash and bonds. You can't get those returns in green without the volatility.
Absolutely. In dollars and cents, because I'm going back to that chart and I've actually highlighted the key numbers here. In dollars and cents, the difference between 10% and 5% over an investor's lifetime is unbelievable. That's why this chart is so damn powerful, all right? I know year end 1925 through the end of last year is almost 100 years. But people are living that long now. Many of you youngins on this call are going to make 100 years. I contend that in many ways, financial planners' jobs are a lot harder today, not just because of all the social media and all the noise and cable TV and everything. That's psychological stuff. The actual mathematical and historical stuff is that people are living longer. When I started in this business, somebody would retire at 65 years old, and most of them were dead in 10 to 15 years. That doesn't happen now. Fast forward from 1981 to the year 2025, you die at 80, people are moaning and crying at the wake because you died so young. You got to be 90 for people not to be crying at your wake, right? Money has to last longer. It has to work harder and last longer today than it did years ago, right? So look at these numbers here. Look at the difference between US stocks way up here. And I know the numbers might be small on the screen that you're looking at, but we're going to send you this chart to put on your refrigerator as a reminder of the power of compounding. Right? And why you need to go through the lifeboat drill so you stay in the game. Look at this number. All right. The US stock number is 16 million. That's an extra comma in there, boys and girls. That's an extra comma. 16 million. That's not a misprint. The bond number over the same period of time is 100,000. Technically 100,829 versus the 16,063,582 in US stocks. That's crazy, right? I mean, just absolutely crazy. You got to ask yourself, why would the capital market gods reward one class of investors so much more than another? What makes those US stock investors so much more rewarded than those bond investors? And the answer is volatility. The stock investors had to hang in there. No jumping in and out of the top line when the weather got bad. Those investors weathered all 365 days of every year. And by doing that, they were rewarded with 3 times the multiple that Justin referred to on the prior slide, right? They got 7, right? 10 minus 3 is 7 versus the bond person who got 5 minus 3 is 2, 2, 4, right? 2, 4, 8, 7.5, 7, right? So they got a multiple of 2.5 times, almost 3x the multiple for spending all 365 days in the market. And spending those 365 days is not easy. And in fact, as we mentioned at the start, it's almost impossible for most investors, especially without some help. And here comes your help, right? Thus, I give you lifeboat drills. All right? Right? The first things first, Justin's going to run through some of this market cycle trends, a little bit of history here.
Yes, the best way not to freak out over the ups and downs of the market cycle is to understand what the market cycle actually looks like and to know roughly where we are in it. This is not an exact science. The stock market doesn't own a calendar. So while we know that sell-offs and bear markets are inevitable, they're coming, we just don't know exactly when they are coming or how long they will last. This is where we need to take our first deep breath, okay? Because living in the unknown, it's not the same thing as living in chaos. Here is what we do know. We know the stock market is random in the short term, but highly predictable in the longer term, typically periods of 5 to 10 years or longer. So we can learn a lot from these historical trends. And according to history, the stock market drops 10 to 15% each year on average. That's correct. Stock market typically drops 10 to 15% each year on average. It drops 20 to 30% every 5 years. We call these bear markets. And thankfully, it only drops 50% 2 to 3 times in a century, but we call these the grizzly bears. These are all types of market corrections or sell-offs, and they are normal. Okay, each one of these, they're all normal. History tells us these corrections have always passed, and they tended to roar back as sharply as they dropped. What does that mean? Well, it means that when the market bounces back, it bounces back very fast. It's not an exact rule of thumb, but here's a quick little example. You had COVID. Market dropped over 30% in 30 days, and then magically in like a month it recovered. You also had the tariff tantrums earlier this year. Both examples that the sell-offs recouped very fast because those sell-offs were very fast and quick in nature. So we don't get windows of time to, leisurely return to the market. And that's why it's important to buy and stay in the game. We don't want to panic and sell because we will miss the recovery. No big deal, you say. A pro like you can handle a few market corrections on the road to long-term riches. This is usually part of the client meeting where John and I hear things like, don't worry, I'm in it for the long haul. I'm no Chicken Little. I won't be worried about the sky and it's falling. Hey, but guess what? We are human beings.
Yes, we are. Like these two human beings on your screen. They look very familiar to me, these two human beings here, right? On the right there, you see Jacqueline Fielding Bodnar Webster with her darling husband, my number one favorite son-in-law, Sam Webster. And the two of them are having the time of their lives on a river in Costa Rica. Oh, we can handle these rapids. We've done this before. Yeah, we're confident human beings. We can look, we can look at the historical averages of this river and as it's laid out on a webinar slide. We can handle it. It's easy. But it's another thing entirely to get your account statements in the mail and see those market drops in practice, like these two did when they finally hit that unbelievable rapid. That looks like a grizzly bear rapid, I think. I think that's the every 25 to 30 year rapid right there.
They held on.
All right.
They held on.
Right. I think the guy in the back there was saying, you could swim, right? You could swim, right? But he's probably saying in Spanish, Jack, in Costa Rica. But so, everybody thinks they can handle it. Say, sure, John. They're looking at this chart and they're seeing these downdrafts and they're saying, they're seeing these downdrafts and they're saying to themselves, oh, I'm in it for the long haul. I can handle it. I can do it. And then they get their LPL statement in the mail and they look like these two. Okay. So this is what lifeboat drills are all about. We're going to go through the actual mathematical exercise and look at the reality of these numbers together. We're going to get out our Ticonderoga #2 pencils and we're going to do the math. And it's pretty simple math. If I can do it, believe me, it's simple math. It's a simple concept, but the whole point of the lifeboat drill, another yuck there, and the point pencil, the point. Do you see my point? So the whole point of the lifeboat drill exercise is to actually complete the exercise of writing it out. Write this out. See the numbers on paper with your own eyes, right? We want to train your brain, just like we've trained our brains, so that when we see a 10 or a 25 or even a 50% dip on your quarterly and annual statements, we need your brain to say, oh, that's normal. That's what Justin was talking about on that slide, right? And we want you to feel like you've seen them before. And we've rehearsed how your proper response is. We need our brains to say, ah, here we are again. I remember this place. No need to go into flight mode. So here we go. Let the fun begin. Everybody get to your muster station. We should have had that sound, Jack. Beep, beep from the boat. Get to your muster station. It's time to run a lifeboat drill together. In fact, I don't know if you can hear it, there's actually a Florham Park police car outside. That's crazy. Perfect time. That's unbelievable. All right. So we're going to use a $1 million account as an example on the slides because it's a nice round number for me to work with. But I strongly encourage you to get your own account balance and do the math. All right. So Justin's going to start by talking through this chart. But here's an example of the classic annual 10% correction with $1 million portfolio. And remember, you can expect this every 365 days. Maybe not every calendar year, but it's going to happen every 12 to 15 months for the rest of your life. Okay?
That is correct. So what you see on this chart here, we're using the S&P 500, and on September 15, a closing price of 6,615. If you have a 10% sell-off, that's 661 points, which would result in a new S&P 500 index of 5,953. So let's use your $1 million. You had $1 million on September 15th. Your account goes down 10%. So you lose $100,000 temporary. The key word in this, your new temporary account balance is $900,000. So I want you to repeat after me. Every year, 100,000 of my $1 million account,
100,000 of my 1 million
will temporarily disappear,
and
this is completely normal.
And Justin wants me to think this is completely normal and I shouldn't do anything about it.
That's right. That's right.
Right.
Can you live with that? Can you keep the faith that the market will recover and that 100 grand will return and then some, as history repeatedly has shown us? Now imagine during all this for a moment the utter enthusiasm and excitement in the studios of CNBC and Bloomberg the moment the index dipped back down into the 5,000s. It'll be one of the best ratings of the year for them. Will you be able to tune them out to keep the faith and stay the course? Yes, you can. Why? Because you are a Bodnar Financial badass, and most of you have been doing this for years. Hey, but that's just a measly 10% correction. We got to step it up now. Let's look at an example of a 25% correction, which typically happen every 5 years or so. So we're using the same S&P 500 closing price on the 15th of 6,615. Now a 25% sell-off is 1,653 points, which results in a new S&P 500 of 4,961. So your $1 million on September 15th, it goes down 25%. That is $250,000, 250,000. So your new keyword temporary account balance is 750,000. We are in a bear market. The S&P 500 dropped into the 4,000s, and temporarily $250,000 is gone for an instance. When will it come back? I'm not sure exactly. History says we should expect these about every 5 years or so, but they always have recovered. Can you live with that? Can you keep the faith that the market will recover that $250,000 and then some, as history repeatedly shows us? Heck yes, you can. Why? Because you ran the lifeboat drill and you knew this was coming. You prepared for it. But now we need to head to grizzly country. And for that, I'm going to hand it off to the big dog.
Yeah, you're going to hand it off to
I'm
the
going to hand it
Grizz
off to the big
himself.
dog
Yeah, the
himself
Grizz,
for
yeah.
that.
Yeah, let the big dog eat.
Let the
So,
big dog eat.
all right. Okay, boys and girls. So, yeah, here's the Grizz. That's My daughter does these slides. Jackie, that's a handsome looking Grizzo, I'll tell you. Doesn't he? I mean, that's a young,
We don't
handsome
like
looking Grizz.
grizzlies.
You don't
but
have the
that's
John
pretty-
Bodnar silver hair Grizz there. So, all right. So now we're dealing with some varsity level anxiety here. All right. This is a grizzly bear, one of the big ones that history says that you'll see if you're a long-term investor. You're going to see 2 or 3 times over the course of your lifetime. We're going to see a couple examples of this in a minute. And when you look at your account balance, half of your portfolio is going to temporarily be gone, and you're just going to want to throw up. And you're entitled to, just go outside. All right. For the young investors in the room, let's take another deep breath here and let that sink in. All right. That if you have an account that's worth $50,000 or $100,000 and it goes down 50%, 100 grand, you lost 50 grand. All right. If you're older like me and you were born before January 10th of 1973, you've seen this movie 3 times since 1973. They don't happen often, but when they do, they're painful. So, I've lived, and the oldsters here have lived through it 3 times. All right. So the math can be a shock to the system. And now imagine the studios of CNBC and Bloomberg and the new guy on the street, Fox Business, the moment that the index drops 50%. The balloons will come down along with the confetti. Your panic is their party. All right. It's a party. Their ratings are off the chart. All right. They want to keep you watching to see if the world is going to end. And that's what they're pitching to you at that point. That's exactly what they want to tell you. They're going to tell you it's different this time. This is the big one. And your friends will tell you it's the big one. Your Facebook feed will tell you it's the big one. Your cousin who always brags about his Robinhood account at Thanksgiving will tell you it's the big one. And the odds are the news headlines are very upsetting at this point. In fact, I need to take a breath here. I need to pause, all right? Because it's upsetting me just talking about how upset people get, right? And you wouldn't be human if you didn't feel panicked on the inside watching the market drop further and further while your entire social circle is shouting that the sky is falling. How will you handle that feeling, right? Imagine, this is like the Weather Channel during a hurricane, right? They keep you mesmerized. Here's the eye, just stay tuned. Here's a couple of, we have to break for a commercial, but come right back, right? That's what a bear market is like, especially a grizz, all right? So the question is, how do you handle that feeling? It doesn't feel good. Can you sit calmly? Let me rephrase. Can you sit semi-calmly? Because I wouldn't be able to sit calmly, and you won't be able to either. But can we sit like semi-calmly in our seat while everybody else is running for the doors? Will you have the stomach required to wait it out? That is why we're here tonight, right? This is the reason. And I know what you're thinking. I'm going to say it out loud right now. Yes, John, I can hang in there. But how long do I have to wait it out? When will this 500 become a million again? All right? Because that's the real question. Historically, bear markets have always recovered. They've always come back. But riding them out takes some time. When you look at this chart, you can see every bear market since 1946. Right? This is post-World War II America. Every bear market since 1946. So it doesn't happen all the time, but it does happen pretty regularly. Now, Justin, I'm going to hand it off to you because I really do need to catch my breath.
Get some water. Get some water. So great chart up here, and all the way to the right, you're looking at the duration column. And if you look at one of the ones highlighted, that COVID era, that super short 33-day bear market, that was really an anomaly. That goes back to that earlier comment I made that usually the bounce back is like a mirror image of the sell-off. All right. If the sell-off is quick, typically the recovery is quick. All right. To be a successful long-term investor, Sometimes we're talking about months, though, or in some cases, more than a year of practicing patience, discipline, and tuning out the financial journalist. Sometimes it might be 100 days, which you see quite a few of those on this chart here. Sometimes, not often, it's 600 days. And even look at the year 2000, more than 900 days of practicing patience, discipline, and tuning out the financial journalist. There is no crystal ball that can tell us when it will end. We just have to keep the faith that it will, like it has every time before in history.
You know, Justin, Harry Truman had a great line. He used to say, there are no facts about the future. But one fact that we know to be true, one fact is that every single market sell-off in history has recovered and then made investors wealthy. We just have to go back to that chart we looked at. You know, how do I know that every single market sell-off in history has recovered and then made investors wealthy? How do I know this? Because just this week, we hit another all-time record. The Dow, the S&P 500, NASDAQ, they're all hitting all-time records. And you can't hit a new all-time record if the market didn't recover from all its prior temporary sell-offs. You gotta recoup the sell-off before you can reach a new all-time high, right? So there are no facts about the future, but the past has pretty much proved to us that bear market sell-offs, all sell-offs, are temporary in nature. Keeping the faith is very hard to do. All right, this is tough stuff, boys and girls. All right, investing in the stock market's not for the faint of heart. Humans are wired to react to fear in order to survive, and down markets are downright scary. We wrote a white paper that's on our website. You can visit it, called Wall Street Needs More Anthropologists. All right. And it's a great piece. And I think Justin's going to run through a couple of historical events that kind of talk about that.
Yep. I mean, because investing in the stock market is certainly not for the faint of heart, right? Us humans are wired to react to fear in order to survive. And down markets, they're downright scary. They're usually marked by some kind of crisis or combination of crises, economic, financial, political, even geopolitical. And while those crises are playing out in daily life, it feels like the end of the world. I mean, the Great Depression, Pearl Harbor, JFK assassinated, oil embargo, 9/11, the financial crisis, the pandemic. I mean, who among us didn't feel like the world was ending at least once during COVID? I'm sure we all did. I did, right? As investors, we have to fight thousands of years of evolution. We have to train our brains to say, no, it's not different this time. The details of the crisis might be unique, but we put our faith in history and not today's headlines. What we call this is going against the herd, and people teach entire anthropology courses on how hard it is to do. Because as humans, we are wired to believe that our safety and even our survival depend on staying with the larger group. Striking out on your own feels very uncomfortable and sometimes downright dangerous. Remember, we are the survivors. We are the children of every interaction where fear and terror were rewarded. This goes back to the white paper that John was referring to, a little story. When two cavemen walked out of their caves way back when, and they heard a rustling in the bush, right? One went over to investigate, and the other was scared and hung back. Now, the guy who peeked around the bush, he got eaten by a lion.
That was actually a saber-toothed tiger.
Saber-toothed, I got it wrong. All right, but close enough, close enough. But the other guy the big chicken. Did I get that right? No. Yeah, yeah. He survived. He was rewarded positively for his cowardice. Guess what? We're the descendants of the chicken, all right? That is why going against the herd, it's very hard to do. Therefore, this is why we do lifeboat drills. We need to retrain our brain. We need to embrace the counterintuitive nature of investing and do this drill again every single year, like it's a booster shot. Every year we need to do this. We need to keep working these mental muscles so that way when the time comes, we're prepared to fight the fear and stay in the game while others are panic and selling. This is lifeboat drills, a mental exercise to prepare you to take no action while the herds run away.
Ah, so let's remind ourselves, what do we get? What do we get in exchange for riding this insane emotional roller coaster? Why on earth do we do this to ourselves? And the answer is simple. Justin, what's the answer? Come on, this is return. There you go. That was a quick quiz, right? Why do we do this? And the answer is returns. We want those real returns, air quotes again around real return. We want real returns that exceed inflation by a multiple of 2 or 3 times. All right? And those types of life-changing returns, 10% or 7 after inflation versus 1 or 2% after inflation in bonds and CDs. Those types of real life-changing returns are not free. There's a cost. You have to pay for them. But that cost is not necessarily in dollars and cents. It's not like you're buying an insurance policy. What's the cost? The cost is being able to stomach the volatility when it shows up, and it's coming when it shows up. And it's going to show up at a completely unknown time. The old Donald Rumsfeld, the unknown unknowns, right? At a completely unknown time. So now it's your turn. Like this young lady in her boots here, she's holding a pencil. I contend it's a pencil and not a stylus.
I think so.
She has a pencil in her hand. So now it's your turn. You need to get your account values, right? You need to dig out your LPL statements, and if you can't find them, you call the office and we'll get them to you, right? You get your account values and you perform the lifeboat drills exercise for all 3 levels. You get out that pencil and you say, what if the stock market went down 10% today? What is my account going to be worth? What if it goes down 25%? And write that number down. What if it goes down 50%? And after you write those 3 numbers down on your statement, and I like the new LPL statements, there's a lot of white space. I like them. They're not landscape, they're portrait. I like the way they're set up. And there's a lot of white space. Write them right on there. And then you ask yourself, can you make ends meet with the resulting number of your lifeboat math? Can you live with that temporary zig until it turns back into a zag? Have we set enough cash aside in your portfolio or in your bank account down at the corner bank so that if all of a sudden the stock market sells off 10, 25, or 50%, you're just going to go on living your best life? All right? That's your homework assignment. All right? So if we've been meeting once a year, your asset allocation should be appropriate for your age, cash flow, and liquidity needs. If it's been longer than a year, call the office to schedule a review and let's make sure. Or maybe you have a major life event coming up that warrants a conversation. Are you retiring soon? Are you planning on using your investments to help pay for an upcoming wedding or to make a major purchase like buying a house or a car? Let's discuss your strategy to sell shares, make sure you have enough cash available, that's what I was just talking about, and meet your immediate needs in the event of a sell-off. And that's another handsome looking bear there. I hope he's waving goodbye to bear markets and not welcoming one here.
Me too.
Right
Me
there,
too.
right? Don't you hope? But he is a handsome, I don't know where you get these bear slides from, Jack. Good for you. So let's finish back where we started.
Yes, yes. So being a successful long-term plan driven investor, right? What does it require? It requires clarity of purpose. Why are we here? To outpace inflation, okay? We need faith in the future. Investors who perceive the world as chaotic, fragile, and forever on the brink of some catastrophe, unfortunately, they're always going to get scared of the markets again and again. We need patience. We need portfolios that were created to fund your most important decade goals, and they shouldn't be sidetracked by the headline news. If your goals have not changed, then do not change your plan. If your plan has not changed, do not change your portfolio. And last but not least, we need discipline. You would not be human if you did not feel the fear, but you must fight the urge to act on it. When your flight instinct is ringing in your head, right? Remind yourself that history has proven over and over again that those who benefit the most and recover the best from down markets, investors with well-diversified portfolios who stay the course and they weather the storm.
All right. So summarize the homework assignment, all right? Meet with us once a year. That's going to ensure your portfolio is well diversified and your asset allocation is appropriate for your life and your lifestyle. Doing lifeboat drills once a year will ensure that you can stay the course and weather the storm like a booster shot. And I love that. You know, you need a little booster shot of vitamin C every while to like keep you healthy here, right? So do your lifeboat booster shot, all right? Whether you do it with us or do it on your own, right? But take the time to get paper and pencil. You should do it right on your statement, but paper and pencil and do a lifeboat drill at home. See these numbers in black and white. I assure you it is definitely worth it. All right, so I think we're coming up on about a little over 45 minutes. I want to thank all of you for being here tonight. That was a lot of stuff. That was like taking it on in a fire hose, folks. But thank you for being here tonight. I hope you found this helpful. And if you need help finding your current account values, I mentioned it before, so that you can perform your lifeboat drills, call this office, call us, right? We can help you find them. We can also help you with the math, all right? Remember, we can't predict or time the markets, but we can plan for it. So everyone, you have a great night. And of course, we can't forget a note from our lawyers, right?
Absolutely.
So we'll let you read that for 1 second.
And
now, as promised, we're going to turn the video back on
Yep.
for you.
Hold on, let me do that.
Stop the share. There we go.
Video.
Oh, wait a minute. How did that happen? Where did these, these things always show up when I do a lifeboat drill?
I don't know.
Where did these come from? This happens every time. All right.
We're here with you though.
Yeah.
We're in the lifeboat together.
Yeah, we're on the lifeboat with the New York Jets live from Florham Park, New Jersey. It's Bodnar Financial. The Jets are down the street. All right.
Good night, everybody.
Good night.